Hello and welcome to my podcast. It's great to have you here. Now, as you may know, in my day job, I help people retire successfully. So a major part of the work that I do is helping people have a successful investment experience. Now, I've spent 35 years in this business and spent many hours researching and developing an investment philosophy that I believe gives my clients the best chance of achieving their financial goals. A few individuals and companies have had a significant influence on my thinking over these last 35 years, and probably few will know more than Jack Bogle and the mutual investment company Vanguard. So I am delighted to have had the opportunity to chat recently with Eric Balchunas, who's the author of a new book about the history of Jack Bogle. Eric is an author and a senior ETF analyst and funds product specialist with Bloomberg. So Bloomberg are the global leader in business and financial data. In our conversation, he explains what his day job involves and also why he became so fascinated with Jack Bogle. With a background in data analytics and research, Eric uses a few technical terms in our conversation that some of you may not be fully aware of, and so I thought I'd just take a moment to explain some of the terms that he uses. The first is ETFs, which stands for Exchange Traded Funds, and writing about ETFs is a core part of Eric's role. ETFs are funds that issue shares which are traded on a stock exchange. ETFs cover a broad range of asset classes and can give exposure to specific markets, specific sectors, or particular investment strategies. Many ETFs track an index in order to provide this return. So, how do they work? Well, ETFs can, as I said, can provide exposure to a variety of asset classes such as equities or fixed income by following the performance of the market index that either the equity or the fixed income is in. So that could be the FTSE 100, the S&P 500, the FTSE All Share, those types of indices. Eric also writes about mutual funds, which are funds that allow investors to pool their money together, and then a fund manager will provide the investment advice on that fund. Unit trusts, offshore funds, open-ended investment companies can all be referred generically as funds. We have a discussion about synthetic ETFs as opposed to physical ETFs. Now, ETF providers can use either physical or synthetic replication to ensure that their ETFs mimic the designated indices as accurately as possible. It is therefore important for you to understand the difference between physical replication, which is ETFs that actually buy and own most of all of the index constituents in order to replicate the index's performance, i.e. the manager will buy the actual shares of the actual companies in the index. And this method is relatively simple, it makes sense and is transparent. But since physical replication involves actually buying and selling the shares in that index, this strategy is inherently labour intensive and costly. These additional costs are ultimately passed on to the investor in the form of a higher total expense ratio. ETFs using physical replication also experience tracking errors, which is not when an ETF does, which is what happens to an ETF when it doesn't perfectly mimic the returns of the index it's aiming to track. So the sources of tracking error could include, as I said, higher expense ratios, tax treatment, and of course dividend timing. Now, personally, I'm a fan of physical replication in ETFs. I get it, I understand it, I think it's the safest way to do it. There is something else called synthetic replication, which generally reduces costs and tracking error issues, but it increases risk for investors. So synthetic replication introduces something called counterparty risk into the equation. So I hope that is helpful. Sit back and grab a coffee and enjoy my conversation with Eric Balchunas. Welcome to the Retirement Cafe podcast, Eric Balchunas.
Hi, very nice to be here.
Great to be chatting to you, Eric. Now, you're an author of some renowned now, and working for Bloomberg. So, for those who haven't heard of you, Eric, and we're going to discuss your books a little bit later, because I'm really intrigued about your work there. But tell me how you a little bit of your backstory. How did you get where you got to?
Yeah, I mean, I was actually in college studying to do biology. And once I took chemistry 101, I decided I cannot do this. So I was one of those people in college, like, what am I going to do? So I can't remember why I did it, but I started writing for the college newspaper, and I really liked that. So I switched over to journalism and communications, and I minored in economics. And those two things seemed to appeal to me. And from there, I applied to Bloomberg right out of college. I got rejected, ended up working at Institutional Investor as a reporter, tracking funds and derivatives. And then I went over to um, the other side, which is PR. I was interested to see all these PR people were sort of behind the keyhole. And I was interested in the access they had. So I went to become a PR guy for about 3 years. It was really interesting. I worked with a lot of different clients, including long-term capital management. I was at a crisis PR firm when long-term capital, which blew up in the 90s, and we had to media train John Merriweather, and that was really interesting. That was my first insight into, well, maybe active isn't the greatest thing. If these guys can't get it right, nobody can. They were all geniuses apparently, and it blew up. Anyway, um, then I think I applied to Bloomberg one more time in the medium. I knew I wanted to work there because it was a perfect job, journalism and economics. And then I got rejected again. Finally, in I don't know 2000, year 2000, a headhunter called me and said she had a couple jobs. That's how good the economy was, by the way. In '99, a 24, 5-year old got headhunted with multiple jobs. It was like the Clinton economy. I try to explain this to millennials. It was unbelievable. Anyway, she lays out the jobs. I swear to God, one was Morgan Stanley, one was Bear Stearns, and one was Bloomberg. Well, thank God I didn't choose Bear Stearns. So I was like, I had remember going to Bloomberg, and I'm like, I really want to work there, and I had been there physically, and it looked like an electric beehive. And so I said, I got to work there. So I took a job there, and when I got the job there, I was just really loving it. I ran around the whole company, writing press releases about this part of the company, that part. So I got to really know the company. And then after 9/11, I decided to move back to Jersey. So I moved to the data office. That was a weird move, PR to data. And in data, I worked there 15 years, believe it or not. And we built out the terminal. If you know a Bloomberg terminal, you go to ETF page, you look at the description page, you look at a search tool. I really helped build all that out and get data for ETFs. So I became an expert in ETFs as a data guy. And then research came at me and said, "Hey, you should write for us. You can write, and you know the data. That's research." So I've been leading up the ETF research team at Bloomberg for 5 years now. And so now I sort of do all those jobs at once. Research is writing, it's data for sure. And you got to be your own PR person these days. You know, you can't, there's no one, you have to go get it yourself. There's a lot of content and stuff. So that's sort of my story in a nutshell. And so now I just basically write about ETFs, mutual funds a little bit too, and I write about all the changes going on, a variety of things, and for the Bloomberg terminal. But then I have a podcast and TV show which can go out of the terminal. So that's how I get some notoriety. But most of my stuff is on terminal, which is if you don't have one, it's a pretty big firewall. But they let us leave to promote it outside a bit, and so that's that's basically my story and my day job.
Brilliant, brilliant. Now, Eric, some of our UK, or probably our most of our audience is UK based, and they may not actually be familiar with who Bloomberg are. Can you give a kind of a little synopsis of who Bloomberg are?
Sure. So Bloomberg is a gigantic financial media company. Most people know them from Bloomberg TV or Bloomberg Radio, but those are not the thing. The thing is this thing called the Bloomberg Terminal, and it's you if you pay us $23,000 a year, it's pretty expensive. You get a license and you can log into this just massive database, all kinds of tools, functions. You can trade through us. It's really a professional service for Wall Street professionals. No advisors, I know you're an advisor, maybe 5% of the advisor world may have access to a terminal. You really have to be into trading, market making, or serious portfolio management. So the buy side and the sell side are big clients. Advisors less so, and that's what we sell. So like I think I'm not allowed to really quote Bloomberg company stuff, but I'll just say the vast majority of our revenue comes from the terminal subscriptions. A little bit comes from advertising, just to give you an idea of how Bloomberg works. But the terminal sort of, I think, allows some of the other things to flourish and get out there. So that's what Bloomberg is, and it is interesting that people still are willing to pay that much for data and functions in this environment. A lot of information is free, but the terminal is so full of value that it's worth it. And that's been, I think, Mike Bloomberg's main thing is just keep filling the terminal with value. In a way, it's almost like the advisor world where a portfolio now has become a commodity. It's pretty easy to put together a 60-40. It's all the other stuff that you just keep adding value to maintain the cost that you charge your clients.
Yeah, yeah. And the other kind of acronym you used was ETF, which of course I know is your speciality and you know a huge amount, but not everyone, especially in the UK, will be familiar with ETFs. They are much more widely available now. Vanguard and BlackRock and numerous other providers of those. But obviously in the US, huge business. So just kind of explain what an ETF is.
Yeah, the simplest way I've heard it described is it's a mutual fund with benefits. It's a fund that holds a bunch of stocks, bonds, or even oil futures. It's diverse, right? And like a mutual fund, you buy into it, you own all those stocks at once. It's beautiful. So let's say you buy the S&P 500 or the Brazil ETF. You have diversification. But the difference is you can then trade it like a stock. So it's like a mutual fund that trades like a stock. In the US, there's also some tax benefits. And this is, I think, really important because ETFs tend to be cheaper. You can trade them intraday, so they have these extra sort of benefits, and the tax efficiency is very good. And they're transparent. A lot of mutual funds don't show you what they hold every day. ETFs do. So it's sort of, again, it's a mutual fund with all these bells and whistles put on top that people love. And that's why they're sort of taking off here. But at its core, and when you file for an ETF, you file under the same law that governs, regulates mutual funds. So it is a mutual fund at its heart. It just gets this exemption that, okay, we can trade on exchange, and that's different. And so this is an ETF is kind of a little bit of a hybrid, in a way. It's between the stock and an index mutual fund. Some ETFs are active though. So I should say a mutual fund and a stock. If you merge those two things, you kind of have an ETF. It's like chocolate and peanut butter, two great invention, right? And so sometimes you merge two things and you get actually the synergies are amazing. And that's sort of what you have with an ETF. So people really like them, and investing has changed. A lot of investing now, even trading, is people want to look at the market like an economist, not a stock picker. There are still stock pickers and bond pickers for sure. But now with ETFs, you can sort of move and allocate your portfolio. If you think China's due for a rebound, you can just go buy the China ETF. You don't need to be an expert in every stock there. Because if you have that mindset and there are no ETFs, you have to research the stocks because you don't want to pick a bad one. Here, you just buy 25 China stocks in one shot. And so people really, especially in traders, love to look for alpha through, ironically, these passive ETFs. And so that's a big chunk of the base of ETFs. And then there's also people who are buy and hold. It's a beautiful thing. People use them for all different purposes. And they all pay the same fee. Mutual funds tend to have staggered costs to pay. The less you can pony up, the more they charge you. ETFs kind of come with the institutional fee for everybody. So I like that. They can democratize investing, both in the investments you can get, but also in the fee you charge. Like my mom, if she's in the Vanguard emerging markets, pays the same fee as Bridgewater, which is the world's largest hedge fund. And that's the first of it. That's really never happened before. Normally, the big guys get lower fees, which is like a regressive tax. So ETFs, I think, have gone a long way. And I think investors appreciate that. I think that's why they're growing.
And This is probably for the slight more nerdy person out there, but I'm going to ask a personal question of whether I should be considering or worried about at any point whether something is synthetic or it's actually holding the real assets.
Yeah, our colleague Rebecca Sind on my team put a note out. I think synthetics, like if you buy the S&P 500, you go out and just get all 500 stocks. Honestly, I'm a fan of physical. I just like knowing they're there. And that was really the ultimate building of the ETF, was to make something like a futures contract that could trade like that, but was physically backed. Because that was a problem in 87. I won't go into details, but it was using futures. And when you have something physically backed, it's just nice knowing it's there. It's in a custodian, your name's on it, you have access to it. Even if BlackRock goes belly up, you own the stocks in IVV. And that transferability is great. Now, synthetics, it has a counterparty risk, but they put up enough collateral that you should be fine. And you can tell me better than I can probably. There are potentially a couple benefits to using synthetics. And our colleague in Europe has said the synthetics are fine, given the rules and collateral. That said, I can't help but having a soft spot for the physical. Just something about knowing that your ownership is secure with a custodian.
Yeah, absolutely, and that's my thinking as well. I mean, call me old-fashioned, but actually like to see the the things in the vault.
Yeah, I'll tell you just a quick story on ETFs that I think help people understand how they work. The guy who invented the ETF is named Nate Most, and he worked at the American Stock Exchange, and they were in third place, and they wanted to get some kind of vehicle that could get more liquidity and volume on their exchange. And he came with this idea to trade a mutual fund, right? That was a simple idea. Other people had tried it, but what he added to it that made it last and sweep the world, because other people were trying similar things, but none of them worked like this. He used to be the head of the Pacific Commodities Exchange. And there he saw this thing called commodities warehouses, where they would store, say, like soybean oil in a locker. Now you could take your soybean oil, give it to this exchange, and get receipts. And then you could just trade the receipts back and forth with people without moving merchandise. So it's a very convenient way to do it, right? Then if you have a lot of receipts and you want your merchandise, you just go back to the warehouse and boom, your soybean oil is right there. All he did was replace soybean oil with the S&P 500 stocks. Your receipt is an ETF share. That's why the first ETF is called the S&P Depository Receipts, SPIDER, right? So I think when people think of receipts as what you get with an ETF, because some people have called them derivatives. I don't know. I think receipts is a better way to put it. It reminds you that you actually can go back to that warehouse and get your soybean oil, metaphorically speaking. And that process is called the creation redemption process. And that is how the magic of ETFs works. Because if you can take receipts and exchange them for the underlying, people can arbitrage that all day. And because they can, the price of the receipt will always stay pretty close to the underlying. Because if it does deviate, somebody can just make a risk-free profit. And that's why people love that. They love something that is priced right what it's worth. There's no guarantees it'll go up, but it should be right around the price that it's worth. And that's a fair deal. And that's why people keep coming back. But anyway, that's a little background on the sort of design of the ETF. That is pretty brilliant, I think, but it came from the commodities world.
And of course, before ETFs came along, we get index funds.
Yes.
And your new book is with it all about the Bogle effect, all about Jack Bogle and Vanguard. So tell me about your connection there, how the book came about, where the idea was, and the backstory to that.
Yeah. So as an ETF analyst, Bogle wasn't a huge fan of him. He didn't like anything that traded, but they did a lot to spread his low cost indexing message for sure, I think. But anyway, the idea for the book was just that I had 3.5 hours of audio interviews with him. I sat down with him 3 times before he passed away. And we had these crazy debates. I mean, I got in there the first time. I thought he was going to be sort of this like old patriarch, like sort of 4,000-foot view guy. But his office was spilling over with papers. And he had like ETF data, and he wanted to argue about ETFs and how much they trade, and he knew all the newest ones coming out. I'm like, man, this guy is like a fund analyst. I mean, he's like, we have the same job. I felt like,
Right.
and we bonded, and so our interviews were intense, full of debate, and over an hour each. So I had 3.5 hours of that. So I was like, after he died, I was thinking, it'd be cool to put this on paper, let my kids know I hung out with this great man, interesting guy. On the on the other side, as a data person, we keep being blown away by the number of flows or the amount of flows Vanguard takes in. They take in 1 billion a day for a decade. Just think about that. Just let that process for a minute. 1 billion is a lot for an asset manager total. Vanguard does it every day.
Yeah.
And the flows that are not Vanguard go to stuff where people just copied them. BlackRock, Schwab, even Fidelity has low cost index funds. So honestly, the whole 90% of the flows are going to things that were directly impacted by Bogle. And I can't really think of another industry where someone had that big of an effect. And the reason that it was such a big effect is that Vanguard's structure is unique. It's owned by the funds. So in essence, the investors own the company. It's like a co-op almost. And why Bogle set it up this way was always fascinating to me. And because he did, the more money it got, the people who voted on what to do with the profits, they're the investors. So they're like, well, just give it to us in the form of lower fees instead of some owner or shareholders that are stock owners. And that is why the first Vanguard fund went from 45 basis points when it launched to now 3. And once it got below 10, that's when the index fund mania started. But it took 40 years to get there. And now we have a utopia where you can get almost everything for free. I really thought he should get a credit and a deconstruction of him and this process, because without it, I think index funds and ETFs have 5% of the assets they have today. It's just Wall Street just doesn't have a motive to voluntarily lower fees. It's just not how they roll. It's a business and it's fine. I get it. That's how it works. And in the book, I say I would have done probably what the other managers did, not him. But that's why you write a book about him, because he's unique. He was very different. And he had to give up a lot of personal gain for that. He had plenty of money. He wasn't like poor, but he certainly, ended his life with about 80 million in total net worth, which wouldn't even rank him on the top 1,000 richest people in Wall Street. So nobody got Jeff Bezos rich here. And I just thought that was just such a great story to cover. And I had a lot of data. And Vanguard also allowed me to go into different areas. I could talk about mutual funds, ETFs, wealth management, trading platforms, behavior. And I did that. I used Vanguard to explore all these areas and how they're changing. Some are changing almost entirely because of what Bogle did, and some maybe he had an impact on, but wasn't entire. But they're all changing rapidly. And throw in the internet, and you have a whole new Wall Street apparatus forming. And I thought this is a great way to do it, to look at all that.
And what do you think? What do you think drove him to take that path when 99.9% of other money managers don't go that path? I mean, he really did. You've got two opportunities. Which way you want to go? And he just went, "I'm going this way, and I'm going on my own."
Yeah, it is a long story. I did my best to consolidate it in the book, but it was Bogle being different. I give him credit, but it was also a circumstance. He had teamed up. He was running Wellington, which was a very conservative balance fund. This is in the 60s, but the 60s were roaring. It was like the last decade, where the ARCs of the world were getting all the money, and the boring stuff was like the value managers are losing. That was the era in the 60s he was operating and running a boring fund. And as he said, well, everybody wants donuts and I'm selling nutritious bagels. I got to sell donuts too. So he teamed up with a ARC like growth manager, high flying growth manager, to give him some sizzle. And what happened was the 60s ended and the 70s kicked in, and all those high growth funds went to crap. Even the Wellington Balance Fund, his new partners had actually made a little more risky, so that didn't stave off any of the downturn. And I felt he felt he had betrayed himself. He was pissed at these guys, and this anger for a solution, or this anger with them, caused him to get fired by them. So he basically got fired by his new partners, and in most people would walk away and just be like, you know what, I screwed up. Let me get a new job. But he's like, no, what, screw these guys. And he figured out, I'm actually the chairman of the funds themselves, so I can fight back. I've got some leverage. Long story short, in order to come up with a deal that they could all work together with, he said, I'll tell you what, I'll run a back office company. I'll just do the admin and the boring stuff. You guys invest, and we're going to make it mutually owned. And that way the board would sign off on it, knowing he wouldn't get any like big payday, because he had to pass all this by the board. And this is so it was largely Bogle looking at an opportunity to restart a fund company, because he did write a Princeton thesis about how the industry should be more like fiduciary. So he was definitely a fiduciary type guy. This situation was unique. It gave him an opportunity to set up something new, and but he had to save his job. I mean, that was a part of it too. So there was a lot of moving parts here, and it's really untangling the truth from this, because in Bogle's own books, he sort of pumps himself up to be like the savior. And when you talk to people who work with him, they're like, well, it wasn't totally like that. So I tried to look at both, but that 1 in a million situation where you actually get in a fight with your own investment advisor, kicked off, one person's the chairman of the funds, but the company has a different board, it's not normal. And so that situation was where this mutual ownership structure was able to be born. And from there, I still think most normal people wouldn't have chosen to do mutual. They would have just, like, they just couldn't have, who would be ready to work 6 days a week and forego and turn all the profits over to the client? So anyway, that back office company he named Vanguard. And over time, it grew out of back office. And the first thing it did was launch index funds, because he wasn't allowed to run money, but he passed it to the board saying, I'm not actually running money, because it's automatic, PM kind of thing. It's like robotically managed. It's not actually running money. So anyway, he was able to cleverly turn this back office company into this big thing. But index funds came a little later on. And ultimately, index funds wouldn't have been as big if that ownership structure hadn't whittled the fees down to nothing over 40 years. Mm. So that's the story. It's unique. I go over in the book. I don't want to spend you could get weeded down in this a little bit because there's some technical details, but I think the main takeaway is it was, I think, half Bogle being a different dude, just thinking differently, and half just a really weird circumstance that was able to produce this unique structure that has not been copied since, which is also one of the reasons I wanted to write this, was how come nobody's copied this? And, I explore that in the book, and I interviewed like 50 people, got all their opinions and whatnot.
Yeah. And let's talk about, you've mentioned a couple of things that I'm familiar with, but again, my listeners may not be. So you mentioned the long-term capital fund that is obviously famous in the US, but maybe not be so much in the UK, which is a fund that went pop. And another recent one, which was the ARC fund which is hugely in the news again, is a US fund that has fallen by the wayside after some stellar performance. But what's really interesting here to me is investor behavior. So we've got some fantastic products that I use, Vanguard funds, passive and our tracking markets. But the on the other flip side, we've got a lot of capital, a lot of people's well hard-earned money following these funds with this, obviously for short periods of time, have stellar performance, and of course, we're human nature seems to attract us to that, and it doesn't. I don't know. It feels as such an anomaly when you put on one hand this 40 years worth of data of what Vanguard and low cost passive investments can do, and then you pop along and offer them something else, and the money flows from one to the other, and people get burned. What's going on?
Yeah, so I will say that I call those things shiny objects. Okay, shiny objects are always going to exist. It's human nature, as you said. I will say the amount of money going to shiny objects is pretty thin. I mean, even ARC at its heyday, I think, had 60 billion. That is, Vanguard takes that in like 2 or 3 months, right?
Right.
Now ARC is down to, I think, 25 billion. So we also see thematic ETFs. like the cannabis ETF, like some of these high flying things, and also crypto. I put all that in the shiny object lane. I don't know that ever go away. What I do see happening, which I think should give everybody some, um, you know, solace on this, is that I think the demand for shiny objects is coming from people who do have a boring core. I think, Vanguard index fund, while Bogle would be thrilled with this and say that's all you need, get all that other crap out of the way. And I put that in the book. Not everybody is as disciplined and Puritan as him. It's sort of like somebody who's super religious versus people who are casually religious. I think people find that boring. I think they find it's like watching paint dry. And I think a lot of them are aware that this is the best deal I'm going to get for the core. Like, let me just keep my money there. But just to scratch the itch and keep myself distracted, I'll kind of buy a couple of other things. I'll decorate the portfolio. It's like a very vanilla meal with some Tabasco sauce on top. And I think that's where you find the arc and the themes and the crypto money. A lot of it is coming from people who have just a desire to entertain themselves a little bit. There's even a term called ROE, return on entertainment, right? Which is a take on return on equity, which is a fundamental metric. But anyway, I think that's going to continue for a long time. In the book, I have a chapter called the fall and rise of active. And I look at how active that takes little bets around the S&P and charges you 1%, that's being replaced by Vanguard, because you can go and get the whole index straight up for 3 to 5 basis points instead of 1. That's a major savings. So the core is being replaced by Vanguard index funds and ETFs and BlackRock, right? That's pushing active to get way more active, ironically. So the rise of passive is making active get wild and crazy. I personally think they're happier there. I can't imagine wanting to run a fund where your big decision that day is whether to have 4% or 3% Amazon. I talk to managers and I don't think they have any fun doing that. So I think what you're going to find is, but that's where the money is. So I think what you're going to find is active gets more active, crypto picking ETFs, Kathy Wood type stuff, thematics. And then the core will get cheaper and be, low cost. So active will become the supporting player in the portfolio. Whereas in the past, it was the star of the show. Whatever 5-star fund was in vogue that year, you'd put it in your core. But then it underperformed, you panicked, sold it, and moved. So I think, ironically, if that stuff over there that's wild and crazy can actually serve as a behavioral hack if it keeps you from touching the 80% that has to be not touched. Because as you know, as an advisor, all that cost savings, everything goes out the window if you don't behave properly. So in the last chapter, I have a chapter called The Art of Doing Nothing. And in there, I give it a cheap index fund, I think is way underrated as helping behavior. If you have a cheap index fund in your core, there's this nice resignation that can take place. What am I going to do? So what, the market's down? What am I going to find some hot manager who happen to be doing better, but then all of a sudden when the market goes up, they are awful, and then I got to move. Screw it. I'm just let me stick to my low cost index fund. I can't get a better deal. Now on the outside, that's where I'll play around, and there's less stress because I know I've got the core stuff covered for a low fee. That's my nest egg. My kids will be okay. And so honestly, it is a sort of ironic situation where the more the core gets safe and efficient and passive, the crazier the other stuff's going to get.
Absolutely. Yeah. Now, the other thing that interests me, especially as some figures I've seen very recently regarding, so we as an advisor, I have something like about 48% of my clients' portfolios in the US market, because that's globally representative of where the companies are listing. And of course, we've had this rise of these huge companies in the US. With such, the Alphabet and the Tesla and the Amazon, etc., and the Apple. I mean, they're just such massive representative parts or constituent parts of the S&P 500. Is this what people are signing up for, do you think, when they bought that S&P 500 passive investment?
You mean signing up for these big,
well,
Amazon
I suppose the
stocks?
huge weighting comparable to the rest of the market.
Yeah. So I hear you, and I thought that too. I was like, man, these mega caps are getting mega. But
Yeah.
somebody showed all the companies that are inside Amazon, inside Google. People forget Google owns YouTube. YouTube would be like a top 50 company on its own, right?
Yeah.
So when you buy a Google, you're buying like 10 companies. So if you look at it that way,
Right.
the S&P top 10 is actually pretty diversified, given how much these companies have acquired. Now, should those companies be broken up a little bit? That's a good argument. But right now, the mega capness, you have to see through the Google name into all of the underlyings, and you realize you're getting exposure to multiple industries, multiple different retail segments. Amazon is into all kinds of stuff. Apple is into all kinds of stuff. Cars, phones. I mean, it's getting pretty crazy to be honest. But that would be my pushback on that. The other thing I would say is the beauty of passive is it, it sort of it sort of gets to ride the best ideas of active managers without the costs. Amazon is big, not because it's in indexes, but because active players love it. They bid up the price. The price then being bid up causes the market cap to grow, and then it gets a bigger weighting. So passive is in the back seat of active decisions. So that is why you have some of those big mega caps as well. Now, does passive inflows maybe help uh, perpetuate that a little bit? Sure, I can't deny it, but we've seen companies go in and out of the S&P. And that's not because passive is doing anything. It's because active likes it, then doesn't like it. Macy's is a good example. That's a department store. Do you have Macy's there?
No.
No. Okay. It's like Harrods. Is that right?
Yeah, yeah, yeah. You're all,
Pretty good.
it's in fact it's in Harrods is really just London, whereas
Okay.
well, in fact I don't think it is just London. But there are retail stores which are across the UK. Yeah. So which I think is what Macy's are, isn't it?
Yeah. You go in there, you can get like Ralph Lauren and Levi
Yeah,
and like they all, oh, yeah.
yeah.
So
Yeah, in
anyway,
fact, our
Macy's,
large department stores have taken a big hit. In fact,
same
probably
here.
one of our largest. But interesting enough, is a company called John Lewis, who actually are in essence a mutual, and the all the employees are partners in the business, and they share in the profits of the
That's
business,
cool.
and so therefore they are not listed on the stock exchange.
And has that company been around for a long time?
Absolutely. In fact, mutuals.
How
I mean, I
long?
don't know. Mutuals were our building societies started as mutuals. Our insurance companies started as mutuals.
Yeah.
In fact, in the 80s, they listed and they gave out their benefits to their policyholders, and they went listed on the market. In my opinion, that was not a good move, and it's a real shame that a lot of these organisations that were there
Have
to
them
benefit
public.
their local communities and their local and the policyholders, etc., have disappeared. But we do still have some large mutual insurance companies and some providers. Yeah.
Yeah. In the U.S., it's in the insurance industry, it's a little greater, but the mutuals last a long time. They've got real legs. The other ones seem to be like, they rise and they fall. But mutuals, it's interesting that you say that, um, because Vanguard isn't alone in being a mutual, but it is very unique in asset management, if not, you know, totally, there's a couple other minor cases, but it's basically the only one. Anyway, back to Macy's. Macy's was big in the 80s, 90s, went into the S&P and they got kicked out because of what you said. It was falling on hard times. Tesla was obviously not in. Now it's in. I don't know, 15 years, maybe Tesla won't be in. It's an organism that changes. Like right now, the percentage of energy oil stocks is going up. Um, that had gone down to like 2%. Now it's up to 4. So it's gonna constantly follow and adapt to active decisions. But yeah, that was my sort of reply to those big mega caps.
Sure. Sure.
Yeah,
And so, Eric, what would you hope to see in the next kind of, to see the Bogle's kind of future and his legacy that he left behind? How would you like to see that play out over the next 10, 15 years?
yeah. I think the big one is this. Bogle said this quote, which blew me away. I did not know this until I researched him more, reading all his books. And he said once to the crew, which is the Vanguard employees, in 1992ish. He said, "I will know Vanguard's mission to make a better world for investors is beginning to happen when our market share begins to erode." And so I think the next phase I'm looking for is when will Vanguard's market share grow? Right now, it's like on a hockey stick. I think it's 28, 27%, but it's headed to 30 pretty quickly, especially in a bear market where the only thing is flows. Because Vanguard's taken in like 70 billion this year. Everybody else combined is like negative 100. So, and that's how hardcore they are. So that means market share is going to pop in a bear market. At some point, though, BlackRock, Schwab, JP Morgan, Goldman Sachs, they all have a line of cheap index funds and ETFs. And I'm looking to see Vanguard's market share. When will it top off to fulfill Bogle's dreams? Which again, that's a hardcore dream. Who's ever rooted for their market share to erode? That's how different of a trip this guy was on, right? It's very weird. But that's what I'm looking for, because what he wanted was everyone else to get cheap and to become good stewards and bank goodwill with their own customers. And it's still not happened. I mean, that was in 91. How many years later is this? This is 20 years later, and the opposite is happening for now. But at some point, that will happen. Fidelity's done a great job with their low-cost funds. And if you look at the Bogleheads Forum, which is people who follow Bogleosophy, it's more Bogleosophy than it is Vanguard. They're fine using Fidelity, Schwab. I mean, they're all about low cost. That's why I call it the Bogle effect and not the Vanguard effect, is that this is bigger than Vanguard. This is a whole religion that he has spawned, which is low cost, simple, basic. That is what is spreading all over the world. And, I have this phrase in the book, addition by subtraction. I believe that sums up his life's work. What he did in the 60s, he just said, let's try to get rid of the management fees as much as possible. Let's get rid of the brokerage fees. Let's get rid of the behavioral bias. Let's get rid of the trading, the turnover inside the fund. So by pulling all that out, he was able to get frictionless exposure to the market, which again, that's why it's so popular, because it's so the customers, clients love it. So I just think that frictionless exposure is now going to be served up by many different issuers, and it is. And so I'm looking to see when that will change, when Vanguard's market share will, in fact, begin to erode. The one Achilles heel they have is their customer service. There's complaints, and everybody interviewed had their own problems with it. When you only, Vanguard has 27% of industry assets, but they only take in 5% of industry revenue. So when you have such a low amount of money coming in, obviously that's why they're so cheap. You cannot throw money at everything. So I think they're going to have a tension going forward of like how much to put in customer service versus other stuff. But it's this problem they have to think about. People don't want to wait on the phone that long. They don't want to be frustrated. They have so much goodwill banked that I think people can get frustrated and still love them. But at some point, you could go, well, I'll just go to Fidelity. I get the same cheap funds and the customer service, because now everybody has those cheap funds. So I think that's sort of what you're going to see moving forward. That's why the book Bogle Effect is these other people copying what he did, and then honestly, that would be having changed everything, right? Not just I set up a company that does this, but now everything's changed, and that's what I would be looking for.
Yeah. And of course, in the UK, I mean, Vanguard are making big inroads, but there are a number of, probably a smaller amount of numbers, like advisors like myself, who use people like that, who use Vanguard a huge amount. But the clients are using me as the interface. You get me the exposure, yes, to get me competitive funds and low cost and passive, and get my allocation correct, my bond and my equity split and my cash flow and all those types of things. But actually, I'm quite happy to pay you a fee to do that bit for me.
Yes.
But still get the asset piece at a low cost.
Yeah, and that there's a great chart Michael Kitces has where people were paying 2%, 1% the advisor, and 1% for their funds. The funds are now nothing, so you're still paying the ones. Everybody makes out, and the advisor has been doing a lot more with planning. And maybe if you're young, you could just use a robo advisor or just buy a balanced fund. But as you get older, you got a lot of stuff. You got things to work out, and the advisor, I think, with taxes and with planning and even behavior, certainly earns their money, and the relationship they have as a psychologist with their investors is huge. And so advisors are in a good spot, I think. I do think there'll be a little bit of cost pressure, especially if you're not doing a ton on the planning side and really earning your keep over there. I think the allocation is a little commoditized thanks to Vanguard and stuff, but still, I think for many people, they like to have a voice there, a person they can go to. Um, and so, yeah, I agree with you. I think it's crazy to me how many of the rest of the world outside the U.S. hasn't switched over to the fiduciary model, which is getting a percentage of assets. Um, if you were to track the percentage of assets that the how many broker versus, we'll call it broker versus fiduciary. If you were to track a line of the percentage fiduciary broker, and then you put passive assets on top of it, it would probably be 100% correlated. That is a direct need. Once your broker stops getting a kickback for the mutual fund company, which is what it is, to put someone in a fund they would never invest in themselves, which is really wrong. I don't understand. That's not how most of the world still works. Yet when they go to percentage, they're all of a sudden on your side because they're like, my money comes from your money. Let's do the best thing. And that's a beautiful thing that when that aligns, and that has been a major catalyst in the rise of Vanguard and passive. I can't understand it. Fiduciary advisors are their fastest growing base. Used to be just direct retail, but now that advisory base is growing big time. So it's interesting it's taken so long in the rest of the world. I know one theory I heard, by the way, is that in the US, um, everybody was pushed to go to 401k plans from like defined benefit to defined contribution. And that made a lot of regular people here have to get like some knowledge about funds and the markets. And just that little bit of knowledge went a long way to pushing this forward. Whereas in other parts of the world, they they're not as active customers of this stuff. And maybe they're in a bank where their parents and grandparents always banked. And it just seems like there's a lot of embedded plumbing that makes it harder elsewhere. But it seems like it's happening slowly, just like maybe more slowly than the how it's happened in the past 15 years here. You may have a
Yeah.
better opinion on that, but that's what I'm hearing.
Yeah, yeah, and you know, we've been on a fee only basis for quite a number of years now as a regulatory requirement. I mean, in essence, commissions are have been banned for a long time on investment products. So yeah, we've had that regulatory um, requirement for a long time, and it's been I think been fantastic for business and for proper financial planning. You know,
So
there's a lot of
so
people.
so with commissions banned, which I think I remember that. Again, I'm 95% covering the U.S. But commissions banned. So is it just an inertia of advisors wanting to show they pick active funds and that's their value add? That's really what it
Yeah,
is. Yeah. Okay.
yeah.
Yeah, that's another element to this whole thing too. Is that
And you know, I often say, Eric, it's a really compelling story. So if if you were a client of mine and you came in and I said, you know, Eric, you know, I've been doing this for 30 years, and I've got I've got all this, I've got a Bloomberg terminal, and it covers all this analysis, and I can pick and choose which has got the past records and et cetera, et cetera. You know, and this is my fund selection list from a retail customer's perspective, they kind of go, okay, well, that sounds quite good. You know, you've got 5 funds there who've got stellar outperformance for the last 5 years. Yeah, that sounds a compelling argument. Comparative to, do you know what, Eric? I have no idea what the markets are going to do. I can kind of show you what history's done. I don't really know which one's going to perform best next year or the year after. So I can kind of get you the average return. Actually, I believe that's what most investors don't manage to do, but I can get you the market return. There's a bit of tinkering around the side that I can show historically that maybe small caps have performed large caps and maybe values over the longer term has outperformed growth. But I don't know when those periods of performance are going to actually come. I mean, you know, again, my crystal ball's broken. Do you want some? You know,
yeah,
and the two stories you see are
sure,
just, you know, my kind of classic or my slow, but you know, I'm just going to let the portfolio perform as nature does,
sure,
which is just takes its time and it will do what it'll do, comparable to the very compelling story about how great I am at picking funds.
yeah,
You can see, you know, in the
yeah,
storytelling
sure,
world, which is what we're hooked
yeah.
into, there's a whole different perspective.
Yeah, you'll never have to explain yourself though down the line. The other person will. They're gonna be like, "Why'd you pick this one?" Well, and at least you can just completely sleep at night with that message because you don't know. Nobody knows the future. That's the big downer to this whole thing is nobody really knows the future, no matter how smart you are, how much experience, how many numbers. There are some things that tend to repeat historically, but nobody knows. Um, the other thing I would say about that is I have a good time in the book where I try to explain how Bogle sold index funds to a culture that you're describing in the US, which is the US, especially. We want number one. We're all about best, number one, top gun, all that stuff. And index fund sounds like total average. So he had to get very creative. And because he was outside of the commission system, he was outside of the whole system. So he had to get you to come out and find them. That was a big effort. That's why it took 30 years for them to get any decent market share. It's a long time of trying to sexy up your message there. But the one thing he did, which I thought was brilliant, was the growth of $10,000 over 50 years. One is when you get 5% annual, and one is when you get 7% annual. The 7% gets you like $300,000. The 5% gets you $140,000. So you're able to basically like double your money based on just 2 percentage points. And one is frictionless cost to a 60/40. And the other is all the costs that you go in trying to find these active managers, the turnover, this. And so that chart I found was impressive. And he had a line he always said, which is that index funds make up for their short-term boringness with their long-term spectacular, wealth creation. So he just tried to keep focusing people on the long term and the power of compounding. And like I said, I give the guy credit because listen to this stat: 97% of Vanguard's assets came after Bogle stepped down as CEO. So here's a guy who built a massive foundation that you could build the Empire State Building on. But that foundation, he toiled around a lot in a similar way that your message is harder when someone's selling, as we said earlier, donuts and not nutritious bagels.
Yeah. Well, Eric, it's been fantastic talking to you. I really appreciate your time. I highly recommend, I'll put a link in the show notes to the book, The Bogle Effect and How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors $1 trillion. Everyone should read it. I really recommend it. I've really thoroughly enjoyed talking to you today. And as I say, once again, thanks for your time.
Yeah, thank you. And I'll look you up next time I'm over there. I go over there like once every 2 years. So we should have some tea. Or a pint. You need a pint. How about a pint? There you go. That's better.
We'll have some warm beer.
There you go. Anyway, it's my pleasure. Good talking to you. And thanks for the invite.
Thanks, Eric. A huge thank you once again to Eric for taking the time to chat with me about his latest book, Active versus Passive Investing, and the legend that is Jack Bogle. Head over to the show notes on our website at theretirementcafe.co.uk for links to Eric's books and to follow Eric on social media. As ever, if you've enjoyed this episode, please do leave us a review on Apple Podcasts, as it really helps more people like you to find us. If you are listening to this episode on your preferred podcast player, but would like to see who I'm interviewing, then head to my YouTube channel, which is Justin King MFP, where I post all of these conversations. You'll also find an array of videos about retirement planning, so there may just be something helpful for you there. So until next time, I'm Justin King, helping you feel more informed in your retirement.